Hey everybody, and welcome back to H Invests. Today we're going to be talking about 5 ways to invest when the stock market crashes. I know this is a very popular topic, so I wanted to deliver my opinion. Today we're going to be talking about defensive stocks. So there's actually going to be a whole series on this, covering each one of the 5 ways, and this is going to be the topic for today: how you can invest in defensive stocks to protect your portfolio when the stock market crashes. If you enjoy my content, please give it a like. It's really helping the channel grow. Comment with your thoughts and subscribe so you don't miss any of the videos in this series or on the channel in general. Okay, so when talking about defensive stocks, I thought it was also important to really think about how does the stock market behave. So what we can see here is we can see a recession where the grey bars are recessions against the S&P 500 plotted over time. And what we can see is there's a recession where we see a slowdown in economic activity and GDP is contracting for 2 consecutive quarters. So the GDP, the kind of overall output in the economy, has fallen for 2 quarters in a row. And what you can see, the general kind of trend of the stock market over time, what's really important to remember is that stock markets tend to rise steadily, as we can see, and they tend to fall quickly, as they did in 2000, as they did in 2008, as they did in 2020. So this is why it's really important to be prepared and to diversify our portfolio, particularly if we have conviction that there is a crash on the way. Okay, so here we go. Investing in defensive stocks. You can see some examples I put up on the screen. If these aren't making sense to you, this will become clear. Do people buy drugs in recessions? Do people buy soap in recessions? Do people buy cookies to cheer themselves up in recessions? Those are the kind of rhetorical questions you want to be asking yourself. Okay, so what is a defensive stock? So as we saw from the last slide, it's a company that makes those kind of products, a company whose profits don't tend to fluctuate very much with the overall state of the economy. So these companies' goods and services are in demand no matter what the state of the economy is, and this leads to more stable revenue even in times of recession, and thus we see a more stable share price where investors have more conviction that the business will survive and sometimes even continue to grow in the recessionary period. Okay, so here we go. I've put a table together highlighting the different industries of the stock market, and you can see their beta or their volatility. That's what this number is. For anybody who doesn't know what the beta means, beta is basically a measure of the stock market's volatility and correlation against the overall market. So if you've got a beta of 1, it means that the stock is more volatile than the market and it will react quicker to upturns and quicker to downturns. If the beta is less than 1, that means it's going to be less volatile than the market. And in some cases, you do have a beta less than 0, although it is quite rare, where the stock has a negative correlation with the market. So here we go. You can see the kind of general stocks by industry here. You've got basic materials, which includes all kind of commodities mined out the ground. There's usually quite a lot of variance in that sector because some commodities are very, cyclical in their nature. When industrial production contracts, the demand for these commodities will contract, and hence the share prices of the companies that mine these materials will fall. Others mine precious metals like gold, silver, platinum, etc., but tend to do very well in recessions. Consumer discretionary, that's basically large ticket items, things like cars, whilst consumer staples are more the bare essentials of what you tend to need. Then you've got energy. This volatility is actually being exacerbated by the high volatility in oil and gas. So when you think about oil, about 68% of oil is used for transportation purposes, and the majority of that goes through to automotive and it goes through to propane, so things like jet fuel. And what you'll tend to see is that when the economy is not doing so well, these oil companies don't do so well because the demand for oil is down, because basically what's happening is all of these industrial companies that need to transport goods and services around, there's less demand to do that. And also what obviously in 2020 we saw a very interesting scenario where the price of oil absolutely collapsed because, well, in many cases it was illegal to fly. It was highly advised you didn't drive your car out and about in the town, and that meant that the oil demand absolutely collapsed, and hence the share prices of many of these companies. Financials, I won't go into too much detail here, because there's a lot of variance in how different financial companies do things. Insurance have a lot of stocks on their balance sheet a lot of the time because they collect so much cash. Other financials like brokerage firms might do okay because even though it's a recession, they make money off people trading the stocks, buying and selling the stocks. So they make money off commission, so they tend to do okay. Healthcare, again, there's a lot of variance in that sector. Industrials, again, general industrial activity will decline in a recession, so industrials tend to be quite volatile. Tech, if you think about all of the products that tech make, if it's hardware or software, if the businesses that buy those products go bankrupt in a recession, those tech companies are going to have less customers, so they're a bit more volatile. And then utilities, people tend to keep their electric on in a recession, so the utilities tend to do quite well. So that is beta by sector. That's trying to work out, that will give you a very good representation of which kind of companies and which kind of sectors are better positioned to survive in a recession. Yeah, but what about breaking this down a bit further? So obviously we have 10 kind of industries there, but what if you broke it down by actual sector in the economy? Let's see what the top 5 are. In 5th, we have the drug and grocery stores that people still tend to go to get their bare necessities. Number 4, we have food producers. So that's actually just a step back along the supply chain. People that make jam, people that make, all kinds of food that the grocery stores then sell. 3rd, you've got the electrical utilities supplying electricity to your house. People won't tend to ring up their utility company and cancel their electric in a recession because they see that as something essential that they don't want to cut back on when their discretionary income falls. Then you've got tobacco. So tobacco is a highly addictive product. It's a relatively low ticket item, so people still consume it in a recession. Particularly if they're stressed out, they will tend to consume as much tobacco as they normally do, or even in some cases more. So tobacco has very, very low volatility compared to the rest of the market. And then you've got precious metals and mining. That is the least volatile. And the reason you tend to see that is that in recessions, people will tend to put their money in other stores of wealth, things like gold, silver, platinum. These precious metal companies mine these kind of metals, and hence they tend to do quite well in recessions. So metals and mining, Heinz tomato ketchup, that would be an example of food producers. You've got Marlboro cigarettes. They're actually produced by Altria, which is a tobacco company. I recently did a full stock pitch on Altria, detailing exactly what I think of the company and whether I think it's a good investment on my channel. I highly recommend you guys go check it out. And then lastly, paracetamol, a type of drug that people will tend to buy even if it's in a recession because they're concerned with their own health and they want to feel good and well, and that is a top priority of most people. Okay, so do I just invest in low beta stocks when there's a crash? Well, it's not quite that simple. The goal here isn't just to invest in loads of low beta stocks when there's a crash, because at the end of the day, sometimes their share prices might still fall. They do have a beta above 0, and so they're still expected to fall some bit. But the whole idea is you want to increase your exposure to these low beta stocks when you have a high conviction that there is a crash on the rise. So then when the crash does happen, your portfolio is much better protected. But then at the same time, if there's not a crash, you don't want to just completely lose out on all the stock market gains, right? So the low beta stocks are a very good way to kind of cap that downside, but also if the stock market continues to go up, you still have some upside exposure. If you guys want to know a little bit more about how to kind of figure out if there's going to be a stock market crash, there's a really good video on my channel, 5 ways to predict a stock market crash. I'd highly recommend you guys go and check it out. So yeah, the rule of thumb is that a stock has low beta. It's only a rule of thumb that it won't fall as much in a crash. It's highly likely that it won't fall as much, but it also matters to check the fundamentals of the business model to really kind of see what's going on there. So the beta can be a shortcut, but it's no substitute for doing that work on the fundamentals of the business model to kind of see if the stock is well positioned and is going to retain its profits going into the recession. So I just wanted to give you an example of when the beta really matters. So we've got 2 gold producers here, and as I mentioned, they were part of the lowest beta category, precious metals and mining, right? And you can see the share price of Royal Gold, you can see the share price of New Gold. Obviously the difference being throughout the 2008-2009 period, which is the massive recession that this kind of red circle represents, Royal Gold did very, very well. It was virtually unfazed. The gold price actually started to do okay in kind of early 2009, and they did fine. But New Gold, they had a big merger. There was a lot going on with the company, and they actually fell a lot in the same period. So these red circles, they're representing the same industry at the same time period, but you've got very different results. And this is why it's important to also consider the idiosyncratic or individual risk to a company, as well as the systemic volatility of the sector or the beta relative to the overall market. So I hope you guys enjoyed that video. That's how you kind of pick about defensive stocks that you can invest in to put a hedge in your portfolio against a recession. I really hope you guys enjoyed it. Leave a feedback in the comments, and until next time, happy investing.